Is the Phoenix real estate market slipping? We're going to talk about that today. We've been gaining momentum in the last few months here in Phoenix, and now we're starting to see some weaker signs. So, is this a new trend? Is it just the season? That's what we're going to talk about today. So, thanks for joining me, everyone. I'm Caitlin McKegg. I'm a real estate broker here in Phoenix, Arizona. First, let's start by talking about what's going on in the economy. Last week, we had some big news. We got the CPI numbers. We also got the PPI numbers. I talked about this last Monday that this would be coming out. And what happened was inflation rose just 0.2% in June, less than expected as consumers get a break from price increases. So it was good news on the inflation front, both for the CPI and then also the PPI came out. Prices rise less than expected in another encouraging inflation report. The PPI is the producer price index. CPI is consumer price. So bottom line, both came out looking positive, which is a nice change and some good news. And so why does all of this matter? Well, first of all, it matters to us spending our money every day because we want to see inflation coming down and not have these insane prices of everything pretty much. But also this is affecting the markets, which then affects mortgage rates, which then affects the real estate market. So this is why I like to share this news and keep track of this and look at it every week. So let's take a look at a few articles here about what's going to go on with our federal funds rate. Again, that is different than the mortgage rates. So they are not one and the same, but everything that happens in the economy and the Fed will spill over into mortgages. And I'm going to talk about that in a minute. Is the wild ride over? Fed faces broader debate as it tees up rate hike. So this continues to talk about recent data suggesting inflation's begun to slow in a faster and more persistent way will likely intensify their debate over whether the coming move will be the last one needed, with policymakers honing in on the key issue of whether the economy has fully absorbed the impact of the aggressive monetary tightening to date or is only beginning to adjust. So the Fed's going to meet, I think it's next week, July 24th through the 26th, something like that, and they're going to determine whether or not they will be increasing the federal funds rate again. The word on the street is that a 25 basis point hike is very likely. It seems that everyone was in agreement about that last time. However, they hadn't had the CPI and PPI data out yet. They had maybe had there was some reaction from the jobs report 2 weeks ago. But long story short, it seems pretty likely that they will do an increase of 25 basis points, especially since this CPI and PPI info came out not too shocking, a little bit less than expected, which is positive. So for the Fed, it says it's too soon to declare inflation victory. So this is Federal Reserve Bank of San Francisco president is saying that it's too soon to declare victory and is basically saying that they will continue to increase the federal funds rate. They want to see inflation down to 2%. So there's that opinion. And again, that's from the San Francisco president. And then we've got Fed open to another rate hike after expected increase this month. This article's talking, again about they're planning on another increase at that meeting, the 25th through 26th. And it just seems pretty likely. But then we have another opinion, and this is from Jeremy Siegel. He is a Wharton professor, is saying that we have a Goldilocks economy, basically saying that we've got strong economic growth and falling inflation. The Federal Reserve's aggressive interest rate hikes since March appear to be working their magic to tame inflation. So he's saying everything's all good. So we have a variety of opinions here. In my opinion, I think they're definitely going to increase the rate again this month. And what happens after that, I don't know, they may back off a little bit. As I've said before, there's a lot of folks out there saying they need to kind of pause and see what their impact is because they've been so aggressive since March of 2022. But we'll see if they do that. This says, to his point, first quarter U.S. GDP growth was revised up to 2% late this month. The Atlanta Federal Reserve's GDP Now tracker, which serves as running estimate for economic growth, is predicting 2.3% GDP growth for the second quarter. That's far from recession territory. So there's a difference of an opinion across the board with everything, but bottom line is the economy seems to be somewhat strong. We're not seeing a huge effect from these rate increases other than the fact that inflation is coming down. So again, why do we care on a real estate channel? Well, mortgage rates are important to look at. And so last week, upon the CPI and PPI information coming out, mortgage rates fell farther into the sixes. So last Friday, they're talking about the Friday before that, because this article came out last week. The average lender was just about as close to the mid sevens as they were at the 2022 peak. Now today, mid to upper sixes are back in fashion when it comes to the top tier conventional 30-year fixed scenarios. So this article came out on Thursday, the 13th. And then on Friday, we ended the day with a little bit of change. They're saying, in short, most of the week's gains remain intact, but rates did go up a little bit on Friday. So if you guys are in a position where you're under contract or, been speaking with a lender about buying, now is definitely a good time to check in with them if they haven't checked in with you already, because there was some good movement in rates last week, and you may have something different now than you did before. So that's my tip for you. Make sure you're checking with your lender if you haven't heard from them. But rates are affecting the real estate market because it affects demand. And that's what I want to talk about today as it relates to Phoenix. So we're going to get into that. But we're definitely seeing a dip in demand here. And transaction volume is low, though it has been lower than normal or lower than the last few years here in Phoenix. Not surprising, but that's what's been happening. And now we're seeing this uptick in rates impacting demand. Now, since rates went down last week, are we going to see demand go back up from that? If so, it's probably going to take a couple weeks to see that reaction. If not, maybe we truly are slipping and it's not as rate sensitive. So let's start with the CMI. If you guys are new to my channel, I am a subscriber to the Cromford report, and they have this Cromford Market Index, which is super helpful to essentially be a predictor of the direction of the market. The way that this goes is any number over 110 here is considered a seller's market, and prices will continue to increase. Now, when I say increase, that doesn't mean we're seeing 50% gains. It just means that prices will continue to rise, even if it's a negligible amount. It's not falling. Demand at 79. That was 80 last week. So kind of the rule of thumb here is any number between 90 to 110 is considered balance. Anything under 90 is on the weaker side, and over 110 is on the stronger side. So as it relates to demand, 100 is normal. So our demand is about 21% below normal. And this has been lower for sure lately, but we had kind of seen it hanging around that 80 mark, going up a little bit, and now we're at 79. Supply is really low. So this is 50% below normal. This has been falling for sure. But when we get in a situation where our demand is also falling, that supply is not going to be eaten up quite as easily, and we'll probably see supply rise. When supply and demand match, you have a balanced market. When your demand outweighs your supply, you have a seller's market. And again, as a caveat, for anyone who wants to say this is not a seller's market, just looking at it in terms of numbers, when demand outweighs supply, we're not looking at 30 offers on every single property, etc., like we had seen in the past. But there is some strength there, and it depends on where you're at in the valley and the type of property that you have and the price point as well. So they have this nifty chart here that is giving us all the major cities in Phoenix. Let me see if I can get this a little bit bigger for everybody. And you'll notice quite a few red arrows on this chart. So the red arrows mean that that city has deteriorated for sellers. And the green arrow means that it has improved for sellers. So this is all kind of based on that seller's perspective, just so you know what they're talking about here. So this is the month over month change. So Chandler, for instance, their CMI increased 11% compared to last month. It's at 331. Remember, when anything over 110 is a seller's market. So Chandler is pretty strong right now, and it increased last month. We have Fountain Hills, that is also a seller's market at 244, but it decreased 8% between this month and last month. And that's not 8% in prices, that's 8% in the CMI. So what this number was last month at 266, so an 8% decrease. So all those red arrows are showing that that CMI went down for those cities, and the green arrows saying that the CMI went up for those cities. So we're continuing to see softening because we're seeing more of these cities with red arrows, first of all. Second of all, if we look at the average change month over month, we've seen a negative 3.3% in the CMI of all of these cities. Last week, when we looked at the month over month change, it was negative 1.5%. So overall, we're seeing deterioration here in the market for sellers. There's a wide range of cities that are improving the most for sellers. Buckeye, Chandler, Paradise Valley are all up 9% or more. And then those moving in favor of buyers, Cave Creek, Glendale, and Tempe, all of those have had about 18 to 23% change in the direction for buyers. So deteriorating for sellers. So if you are a buyer and you're interested in those cities, keep an eye on them because they are weakening for sellers. But if you are a seller and you're in Buckeye, Chandler, Paradise Valley, you've seen some improvement. So that's good news for you. But demand is really sensitive to rates, especially here in Phoenix. And so we're seeing the impact of those higher rates than when they were in the sevens for the last few weeks, and we've seen demand go down, and that is showing itself now in our charts here with all the various cities. Now, is that going to continue? Possibly. I'm not sure if this weakening is just seasonal, if it's rate sensitive, or if we are really starting to see some change, maybe a double dip in our market here. It's hard to know for sure. Typically, summer is slower, so I'm not shocked by this. However, if things don't start to come back, if we see rates, if that demand doesn't start to come back, as we see rates staying in the sixes, then we might be in for some market softening. So we'll see. Are we slipping or not? What do you guys think? Put it in the comments below. If you have any questions, check the description. I've got some contact information there where you can submit questions. If you are thinking about buying, selling, or investing, you can always reach out to us with your questions. We'd be happy to help. We also have some links in that description where you can check your instant home value or search our MLS for homes for sale. So don't be shy. Reach out with anything. And if we can help you out, we certainly will. So I'm Caitlin McKegg with the Desert Dreamers team. Thanks for joining me on this Monday, and I will be back on Friday with some more market information for you. Have a great week.